Welcome to the Deep Dive. We're here to cut through the noise of earnings season for you. And today we are digging into Westinghouse Air Brake Technologies, WAB, and their Q3 2025 earnings call.
Yeah, and this one's interesting. It's a bit of a paradox, really. You look at the numbers. WAB delivered a very clean operational beat. They raised guidance, tightened it up. Execution looked solid.
But the market reaction.
Exactly. The stock actually closed down 2.31%. And look at the volume way up, 1.7 million shares traded versus, the usual 1.1 million average.
Okay, so that's the puzzle we need to solve today. Why does a quarter that looks fundamentally like a textbook success, a real operational win trigger, that kind of selling, that kind of anxiety?
It really felt like a quarter that had it all on paper, but clearly the tape, the market, it just absorbed it negatively.
So it's that classic tension, right? Near-term worries versus the longer-term story.
Absolutely. You've got investors maybe pricing in risks they see right now, tariffs, maybe some macro stuff. But management, they're painting a picture about earnings quality, years down the line.
Our job then is to figure out which side of that argument holds more water after digging in.
Let's do it.
Okay, let's start with the headline numbers. The ones that on the surface looked pretty good. Adjusted EPS.
Came in at $2.32.
Which was what? Consensus was $2.23 to $2.28, so a clear beat there.
Definitely ahead of the street. And revenue landed at $2.89 billion. Also just a tick above the $2.88 billion consensus. That's 8.4% growth year over year.
Solid growth. So those numbers, they confirm WAB hit their targets operationally.
They do. But that stock movement, it swung quite a bit intraday, right? Over $17 range. It suggests the market wasn't really arguing about if the quarter was strong. It was more about, okay, what did it cost to get there? And what headwinds are maybe coming up next?
Right. So let's unpack the how, specifically the margins, because that seems like a real execution story. Adjusted operating margin hit 21%.
Yeah, 21.0%. And that's up 130 basis points compared to last year.
130 basis points. For folks maybe less familiar, what does that kind of jump actually mean for a company this big?
It means they're squeezing significantly more profit out of each dollar of sales. A basis point is tiny, 0.01%, so 1.3 percentage points more margin. And that came from a few places. Better gross margins, yes, but also really proactive cost control, some favorable timing on contract escalations, and importantly,
the new acquisition.
Yes, the contribution from the inspection technologies business they just bought. That was key.
Okay, so it wasn't just like tightening the belt. That acquisition timing was crucial. It shows they can integrate something new and get that margin benefit almost right away.
Exactly right. That's the portfolio shaping strategy really paying off, right now.
So when they say accretive about an acquisition,
it means it boosts earnings per share pretty much immediately. And in this case, it looks like it was margin accretive straight out of the gate. It really speaks to the quality of their M&A process, their pipeline.
And visibility, that remains just, staggering. Total backlog at $25.6 billion.
Yeah.
All-time high.
Yeah, that's years of predictability baked in.
But I want to focus on the 12-month backlog. That was up 8.4% year over year. Why is that 12-month piece maybe more relevant right now than the huge total number?
Well, the total number gives you that long-term comfort, absolutely. But the 12-month figure tells you how much revenue is, essentially locked in for the near future, for the next year. Management actually pointed out that this gives them better coverage looking into 2026 than they had at this point last year looking into 2025.
Which is a huge asset in this kind of uncertain global environment, right? That visibility.
It's a premium asset, definitely.
We should also touch on cash flow because, overall cash flow was lower year over year, partly due to those tariff payments, which we'll definitely get back to.
Right.
But management sounded really confident about hitting over 90% operating cash flow conversion for the full year for FY25.
They did. That signals strong conviction in the underlying business, despite those headwinds.
So they're basically saying, we've got this near-term working capital issue with tariffs, but our fundamental ability to turn profit into actual cash. That's still sound.
That's the message.
Okay, let's break it down by segment. Freight and transit both saw pretty solid sales growth, right? Around 8.2, 8.4%.
Yeah, very consistent growth across both. But the margin story in transit was particularly impressive, jumped 2.7 percentage points.
to 15.5% margin in transit. Wow.
Yeah, transit's where you really see that strategic portfolio stuff shining through. They're integrating, streamlining, focusing on, high differentiation areas. Management's even talking about pushing for high teens margins there eventually.
Yeah.
So still potentially more upside in transit.
Okay, but despite all these positives, you mentioned the market got spooked. Was it the mix within freight? Because services revenue was down?
That's a sharp point, yes.
Yeah.
Services revenue, which is typically your stickier, higher margin aftermarket stuff, it was down 11.6%.
Why?
Fewer modernization deliveries, mods as they call them, especially in the back half of the year.
So how comfortable should we be if short-term equipment sales are kind of masking a dip in that core aftermarket business?
That was definitely a focus in the Q&A, and it's a fair question. That drop in services was offset by a huge jump, like 32% in equipment sales. Mostly new locomotives finally getting delivered after some earlier delays.
So management's defense.
Their defense is basically that they're actively shaping the portfolio, they're getting out of some lower return businesses and deliberately focusing on these highly strategic acquisitions, like inspection tech.
So it's a conscious trade-off, maybe sacrificing some lower quality volume right now for better margin and, well, higher quality business down the road.
That seems to be the strategy, quality over quantity in a sense. And remember, they also mentioned those upcoming deals, Dellner, Freyr, Sensor Tech, which aren't even baked into the current guidance yet.
Right, those sensor acquisitions. Small now, but maybe key for the future mix, the future margin profile.
Exactly. They're betting on the quality of revenue long term, even if it means a bit of short-term lumpiness in, say, mod deliveries.
Okay, this feels like where the international story really comes into play. It almost overwhelms that domestic complexity, doesn't it? WAB is acting like a global giant right now.
Oh, absolutely. The real engine for growth at the moment is that international demand. Transit and locomotives. I mean, the headline grabber was that massive Kazakhstan deal, $4.2 billion with their national railway.
Just think about that number, $4.2 billion. How many locos is that?
300 locomotives delivered over 10 years. And crucially, plus long-term service agreements that average over 15 years.
So you're talking about locking in essentially 10 to 15 years of guaranteed, stable international revenue.
Right now.
Yes.
It dramatically insulates them from, whatever happens with the U.S. economy day to day. It's a huge competitive advantage, the definition of durable revenue.
And it wasn't just Kazakhstan, right? They mentioned other areas.
Yeah. Strong activity flagged in Asia, India, Brazil, the CIS countries. Places where big infrastructure spending is, frankly, a government priority, almost non-negotiable.
Okay, but then we hit the North American speed bump. Management couldn't ignore the softness there, right? The railcar build forecast.
No, they had to acknowledge it. They reduced the industry forecast for North American railcar builds again for 2025, down to about 28,000 cars.
That's quite a drop. It definitely signals caution domestically.
And that is precisely the source of that near-term risk that seemed to spook the market. No question.
However, management pushed back pretty hard on the idea that North American fleet upgrades are, purely optional, right? Discretionary spending.
They did. They framed it much more as a necessity.
And this is where we need to get into the weeds a bit. They said over 25% of the North American fleet is over 20 years old. And a similar amount are still old DC locomotives.
That's the key statistic.
They argue modernization is needed for better operating ratio. Okay, quick explainer for everyone. What's the operating ratio and why does upgrading the fleet help it?
Right. So operating ratio, or OR, it's a critical metric for the big railroads, the class ones. Simply put, it's their operating expenses divided by their revenue. Lower is better. It means the railroad is more efficient.
Okay.
Now, if you're running locomotives that are, say, 25 years old, using older DC tech, you're burning way more fuel. You're spending a lot more on maintenance, dealing with more breakdowns, unplanned downtime. So putting in new, modern, efficient locos directly cuts those fuel costs, slashes maintenance expenses, improves reliability. It forces that OR number down, makes the railroad more profitable.
Okay. So WB's argument is, even if the economy feels a bit soft, the railroads have to keep modernizing just to control their own costs and stay efficient.
Exactly. It stops being this sort of capital spending luxury item and becomes more like a non-discretionary cost avoidance strategy for the railroads themselves.
Which is why WAB projects their core services segment will still grow, 5 to 7% next year, almost regardless of the macro picture?
Precisely. Because the fleet is getting old and efficiency demands modernization. That's the thesis.
Okay. Which brings us nicely, or perhaps uncomfortably, to the biggest short-term cloud. The tariffs. Management mentioned them quite a bit. Where are we with that impact right now?
Yeah, this is the risk that definitely overshadowed some of the good news. Management was clear. The peak impact, both gross and net, of those tariff costs hitting the P&L, the profit and loss statement that's still coming, expected over the next couple of quarters. Those costs hit cash flow first, which is why the operating cash flow number was down year over year this quarter.
So how confident are they about managing this, especially since they actually raised guidance despite knowing this cost peak is still ahead? That seems bold.
It does seem bold, but they detailed a pretty robust four-pronged plan to mitigate it.
Okay, what are the problems?
One, getting exemptions where possible, like through USMCA trade agreements. Two, shifting parts of their supply chain, moving sourcing. Three, negotiating cost sharing with their customers. And four, just deep company-wide cost control efforts.
And the proof is in the pudding, right? Raising the guidance.
Yeah, I think so. The fact they raised the midpoint of the FY25 adjusted EPS guidance by 10 cents, now targeting $8.85 to $9.05 while keeping revenue guidance flat. That signals extremely high confidence in their own operating leverage, their own execution, to basically power through this tariff friction. They're betting on their internal strength winning out over these external headwinds.
So the guidance raise is management effectively saying, yes, we see the risk, it's real, but we are confident we can execute well enough to beat it.
That's absolutely the takeaway message from that guidance move.
And looking further out, that strong backlog gives them good cover for 2026, too.
Yeah, they expect combined new loco and mod volumes globally to keep growing next year. And that whole portfolio transformation, getting out of lower return stuff, adding inspection tech, Freyr, Delner, it just reinforces that longer-term story of, better mix, better margins.
All right, time for our regular segment. This is not financial advice. We pivot now, take everything we've just discussed from the call, the numbers, the sentiment, the friction, and spin out an outrageous but maybe plausible trade idea. Just for discussion, of course.
Okay, so the core thesis here is that the market reaction, that sell-off, was flawed. It felt overly focused on the known, near-term stuff. The tariff headwinds, the soft North American railcar builds, and in doing so, it seems to be completely ignoring or at least heavily discounting that massive long-duration international backlog, especially Kazakhstan, and the accretive margin-boosting M&A that's really setting up 2026 and beyond.
So the bet is basically that the market's got the duration wrong, focusing too much on the next 2 quarters, not the next 10 years. How do we structure a trade around that conviction?
Well, the pitch is essentially a relative value play. Betting on WAB's durability and quality against maybe a weaker peer, so you'd initiate a leveraged long position in WAB equity. It's trading around, $193.43 right now?
Okay, long WAB.
And at the same time, you'd short a competitor, specifically one that's heavily exposed to that softening North American railcar market, and crucially, one that lacks WAB's kind of massive long-term international growth engine like that Kazakhstan deal provides.
Got it. So it's like a quality hedge. You're leveraging WAB's stability, its strategic shift to higher quality transit, that huge international backlog.
Exactly. You're betting that the superior earnings quality coming from those multi-year, high-margin international contracts will ultimately win out, that it will overwhelm these temporary tariff costs that clearly spooked investors on the day. It's a bet on that $4.2 billion international backbone versus the softer U.S. periphery noise.
Makes a lot of sense, especially given that stark divergence between the operational results and the immediate market reaction we started with. So the key takeaways seem clear. Operationally, a very strong beat, powered by good margin expansion and that record backlog. But offset, at least in the market's eyes, by that tariff cloud and some short-term profit-taking linked to macro worries.
Right. And maybe a final thought for you to chew on as you digest all this. Considering how management framed North American fleet renewal as almost non-discretionary, and looking at that massive $25.6 billion backlog, how much of that tariff cost impact is really already baked into the share price down here around $193? And maybe more importantly, what kind of order news, perhaps another huge international win, would it actually take to break WAB out of this volatile range and get the market to fully re-rate the stock for its long-term quality?
That question of timing. When does that near-term risk finally give way to the market recognizing the long-term opportunity? That seems to be the key for WAB's next move. Excellent analysis. Thanks for joining us for this deep dive. We'll look forward to connecting with you again next time.